My name is Katie Elliott. I am an associate director at Stan Johnson Company. I work in our corporate finance group and specialize in sale leaseback transactions, working with corporations as well as private equity firms with industrial, office, and retail assets. So, a sale leaseback is a transaction in which the owner of a building sells their building to a purchaser and then leases back that same building from the purchaser while also remaining an occupant in the building. And then, typically during the diligence period or prior to closing, a new lease is negotiated in which the deal terms, such as the rental rate information or the length of the lease, are negotiated. So there are many reasons why someone may consider a sale leaseback. I would say one of the most popular reasons probably has to do with paying down debt. But there are other reasons, such as investing back into the business so it can grow. A company may want to acquire another business in the form of an add on acquisition and would use the sale leaseback proceeds to do that. There are companies out there that they are growing incredibly rapidly. We see this a lot with manufacturing companies. They may want to use the proceeds of a sale leaseback in order to expand their existing footprint or even build another building. There are groups out there that may just want to divorce the risk of owning the real estate and their business together because who would want their life's investment to be wiped out if the business hits the rocks and you also own the real estate that the business occupies? I would say there are also groups out there that want to mitigate the risk of future obsolescence with their real estate. I mean, think about the past year during the pandemic and how much we have used or not utilized buildings in our world. Think about the office buildings that are out there. There are also data centers. There's heavy technology real estate like the data centers that are prime candidates for sale leasebacks. Technology changes incredibly rapid. Data centers are very expensive to build. And so this might be something that an owner of a data center, an enterprise user of a data center, may want to consider a sale leaseback on as well. So, owner users are the obvious answer to this question, and it can be anyone from large corporations to smaller single unit owners of a business. Albertsons, for example, in 2019 did a big sale leaseback on some of their distribution centers. Last year in 2020, Big Lots did a $725 million sale leaseback, and their stock price increased 30% on the news of that occurrence. Our team has worked with Delta Airlines to monetize a number of their assets, but a sale leaseback is not just for large multinational corporations. They work great for small businesses. We've done deals with a childcare operator, for example, that has anywhere from $3 to $4 million of revenue. And they are interested in, as I mentioned earlier, divorcing the risk of their business with the risk of owning real estate. And so it can be a candidate for any type of company out there. And I will say that one of the recent groups that we're seeing become more active within this sector are private equity firms. So, some of the reasons that private equity firms are considering sale leasebacks have to do with some of the same reasons that we see with just a regular corporate owner of real estate. And that has to do with paying down expensive debt. They may need to expand the building of a manufacturing company that they just purchased. Maybe they want to shore up their balance sheet, raise some capital, and increase liquidity. But I would say one of the main reasons private equity firms are considering sale leasebacks has to do with the value creation, because typically there's an underlying arbitrage between the business EBITDA multiple and the effective real estate multiple. Given where cap rates are today, the implied multiple on real estate is anywhere from 11 times to maybe 16 times. Now, if a sponsor is buying a company that is 8 to 9 times EBITDA, and they can sell the real estate for 15 times EBITDA, well, that's a big value arb there. The ability to potentially raise additional millions of dollars of proceeds for the acquisition of one of their businesses. And obviously, another way to raise equity for a transaction. And candidly, that leads me into another reason why a lot of private equity firms are considering sale leasebacks, and that has to do with acquisition financing. Um, this can be done either post-close. A sponsor can buy the company, close on it, and then do a sale leaseback after the close of the business. Or there's groups out there, there's investors out there that are capable of doing what we call a simultaneous sale leaseback. And that means they are able to come alongside the sponsor and close on the real estate as they close on the business, and the funds from the closing of the real estate actually funds the acquisition of the business. Given where cap rates are today, this can be an attractive source of financing. And also, it could potentially be a way to differentiate the sponsor from some of their competitors if they are in a competitive bid situation, because it could be a way for them to get some increased proceeds to the seller, or some of the other groups may not just be thinking about the real estate in this manner. So there is definitely a tiered approach to sale leasebacks. One of the tiers is called a partial sale leaseback, and that is when the owner occupant of the building sells and leases only a portion of the building, leaving some vacant space to give some upside to a potential investor. For example, let's say you are an office user, you have a 100,000 square foot office building, and during the pandemic, you realized I only need 60,000 square feet for my employees because we either downsized or people are going to continue working remotely post pandemic. Well, you can sell the entire 100,000 square foot building, you can lease that 60,000 square feet, and then the potential investor will have that 40,000 square feet that they can lease up to potential another one tenant or perhaps multiple tenants for that space. There's also what we call a short-term sale leaseback. An example of this would be, let's say in 2 to 3 years, the building that you are currently occupying is no longer functional. You're consolidating the business unit. It's not an asset that you continue to want to own. Well, if you do it 2 to 3 years in advance, you would be giving a potential investor 2 to 3 years of rental income cash flow, and then as a result of that, they'd be willing to pay more for the building today with the income on it rather than if you were just to sell a vacant building at the end of the 3 years when you are going to move out of the building. So it's a way to get a little more cash today for a building you know you're no longer going to occupy. So we are predicting an increase in interest rates over the next 12 to 18 months. And the reason for that is because the odds are high that the 10-year Treasury will hit 2% in 2021. Today, the 10-year Treasury is at about 1.68, and back at the end of February, we were at 1.3%. And so, really, this is showing us that we're seeing a steep increase in rates. But what does this have to do with the sale leaseback market? Well, a couple comments to that. First of all, back in October of 2018, we saw the highest watermark for the 10-year Treasury over the past 5 years. It was at about 3.2%. Now, 2018 was also an incredibly strong year for the net lease market. We had about $70 billion of total transaction volume, and cap rates were also at a historic low. Across the industry, across all asset types, in 2018, cap rates were at about 6.19%. So, what about 2020? The 10-year treasury was essentially at zero. So, where were cap rates? Well, interestingly, they were pretty stable. Again, across all asset types in the industry, the cap rates were at 6.19%. Why would this be? Well, what we saw last year in 2020 has to do with what we call a rise in essential real estate. And this is real estate that is essential not only to the daily lives of Americans, but also mission critical and operational for the company. Think about grocery stores, think about drugstores, think about data centers that we used the heck out of last year with all the streaming we did for entertainment or Zoom calls that we did for work or school. So, what we believe is that over the next 12 to 18 months, cap rates are going to remain stable and that there's going to continue to be an appetite for these mission critical assets. And where we are seeing this the most, candidly, is in the industrial sector. What we learned during the pandemic is that you cannot manufacture from home. These facilities were vital and intrinsic to our lives. And the result of that is that we've seen groups and funds raise a tremendous amount of money for these types of assets. They are specifically targeting industrial sale leasebacks because they are sticky for the company and are proving to be invaluable to our lives as Americans. And so, as a result, we think cap rates are going to remain stable over the next 12 to 18 months, as long as the 10-year treasury increases at a measure moderated pace rather than a steep, sharp increase. I would say right now the market is ripe for sale leasebacks. And generally speaking, what we saw back during the Great Recession in 2009, 2010 was a flight to quality. It was a flight to mission critical. It was a flight to credit tenants. It was a flight to long-term leases, and that is what we are seeing today. It's a place where investors can allocate capital. We believe that it is a seller's market, especially for mission critical industrial assets. And if there are companies out there that are considering this as an option, we believe that it's definitely a time to take a serious look at it because it'll be a seller's market and a high value.